All right, Ron Toy with the Ron Toy team at Cross Country Mortgage, giving you a market update so that you are aware of what's going on in the mortgage space, real estate space. We are continuing to see the markets rebound and rates drop. Let me move my head out the way so you can take a screenshot, and I'll walk you through each of the highlighted sections so you know what they represent. But let me move my head. So, what we're looking at here is a picture of the bond market. And what I've got highlighted on the left is the UMBS 5.5% coupon, the bond market price at 100.9, and then the times selected. So that when you are comparing rates, you're comparing apples to apples. That's why when you're asking about the rate, you want to ask, what is the bond market price that this rate is attached to? And what coupon, so that when you're shopping, you're getting an apples to apples comparison. Because if you call me at one time and another lender at another, you might not have the same bond market price. But as you can see, bonds are rallying since the beginning of July. We've seen a 276 basis point improvement. Let me move out the way again in case you just joined. Hey everyone, if you have questions, put it in the comments. I'm a licensed residential mortgage loan officer giving a market update on what's going on. And I'll explain why there's been a movement here next, but I want to get my head out the way so you can see this and screenshot it. So let me move. Oop. Again, since July, we've seen a 276 basis point improvement, which is awesome. The higher that number, the lower the interest rate. And I was also showing people what they need to look at when they're shopping rates. You want to ask what's the bond market price, which I showed you right there in the top left. That's 100.9. And what coupon that the rate is attached to. Ask those questions so that when you're calling around, you're going to get an apples to apples comparison. But let me show you what's so important about this, because today, the revisions to the job data came in and over 818,000 jobs were overstated. And it's typical when they're doing estimations on job numbers every year. But this shows a significant impact to jobs, and the Fed's policy of monetary tightening, increasing the Fed fund rate, has been working. And actually, we should have seen better rebounds throughout the year if the jobs numbers were accurately reported every month. So we have a huge correction, 818,000 jobs. That's almost 68 or 70,000 jobs per month over the year that were overstated. And it happens. They have to use birth death models and all this other things. So I don't want to cause any worry or conspiracy. It's typical for the BLS to do these things. But when they have revisions and the Fed is waiting for the jobs market to be less stable for them to start making cuts, this is going to help. And so everybody's leaning towards, we were thinking maybe 25 basis point cut in September on the 18th, maybe a 50, fingers crossed a 75. But let me show you what the market's done in the last year so that you can kind of see what we were looking like back in October and how much of an improvement we have had there. So let me show you. Pulling up the next one. There you go. Let me move my head out the way. Boom. We've had a 721 basis point recovery since October. This is why rates are coming down. You're starting to see them in the sixes again. And if you get temporary buy downs or buy downs back in the threes and fours, because we're seeing this kind of change and impact in the market since October. And a lot of us loan officers have been out here telling people, hey, be ready, get ready. Things are going to be changing. And this is going to be huge. And I'm excited for it. But this is why I like to give updates on a day-to-day basis at this point, because I don't want my clients or the people watching me or paying attention to my content to miss out on opportunities in the market that can help them grow long-term generational wealth through homeownership. If you got questions, put it in the comments, but this live is really to help clients, realtors, lenders have some information that they can then use to contact their clients and say, hey, I just watched the live and this guy was showing you how the market is improvement. And absolutely, and being 100% legit and talking to people. So thank you so much, Miranda, for joining and interacting with the live. But yes, being real and buying what you can comfortably afford is the key in this market, and not overextending yourself or over leverage in any of your positions, so that you have the freedom and to live life, but also not missing out on an opportunity, thinking that somehow the home prices are going to drop significantly, or waiting for interest rates to drop to the best point ever. You can't necessarily always time the market. It's just being prepared and having the best rate lock strategy in place. And loan officers are great. We're going to have these conversations with you. I'm not the only one that's on here helping people. Go follow the loan officers that are in each other's lives, and Cat Loans and Carlos Munoz and Miranda, who's in the comments now, and interview your loan officers. Find out who aligns with your current and long-term goals, because this is a relationship business, not a transaction business. And so we want to see you win. And everything we do, we want to make sure it aligns with your current and long-term financial goals. And one of the key pillars to building long-term generational wealth is home ownership. And I showed you the charts yesterday, the home price appreciation data since 1942. This is important information so that you feel comfortable and confident in your buying decision or refinancing decision. Because right now, people are getting inundated with offers to refinance. And there needs to be certain levels of questions asked before refinancing actually goes through. And because net tangible benefit is important, but sometimes you can manipulate numbers to make it seem like it's a great idea at that time. And sometimes it really isn't. Like, how long do you plan to be in the home? Are you going to be in it another 2, 3, 4, 5 years? Maybe it's time. But if you're thinking about selling in 12 months, don't rob your equity by doing a refinance to save a couple $100 if you can wait. Now, obviously, some people are struggling with the payment because their escrow accounts adjusted and some other things. That's why you have to look at it with a licensed residential mortgage loan officer who's interested in your long-term goals. Because there are going to be transaction people who do not care. They're just looking for a commission. They're going to mail you a bunch of stuff, call you, all the things, saying, hey, it might be a good time to refinance. Maybe, maybe not. That's why you need to have that conversation. Know your plans, know your budget, know your goals. Because some people are getting refinances to pay off their credit card debt, because credit card debt's at an all-time high in our country. Almost $1 trillion, or a little over $1 trillion in credit card debt. That's a lot. But if you pay off your credit card debt by getting a refinance and don't stop the habits that got you in the credit card debt in the first place, you're going to be in a double worse position, because now your credit card debt will get racked up again, and you would have robbed your equity by rolling in the costs to pay off those things in a refi. Again, this is the difference between having a relationship with a loan officer and a transactional relationship with a loan officer who doesn't care about that. Just ask questions, interview. And I know this process can be stressful. It's in the top 5 stressful things a person does. Maybe they do it 2 to 3 times in their life. We do it all day. And that's why I like to talk to people about it and share. If you have questions, put it in the comments. Love to answer anything you got. But today, the bond market's up. We're at 100.9 right now. Fantastic news. Again, some of the reasons they had the revisions to the job data, which the Fed has been kind of stuck on their Fed fund rate because the job data has been so stable and increasing every month. And even though inflation's been coming down, we're under 3% for the first time since 2021. The Fed fund rate hasn't changed. Now, everybody's anticipating on the Fed fund rate to be reduced on the 18th when that decision comes out, maybe 25, 50 basis points. Fingers crossed for 75. But this new jobs data that just came out, the revisions, should help the Fed be a little bit more motivated to make that cut, because it's a clear sign and indication that their monetary tightening policies are effective, that jobs are not as secure, inflation is coming down, spending is coming down, which we all see. PCE coming out next week on the 30th, that's going to be huge. And as we continue to go into like the updated jobs reports that's coming in like the 6th of September, this is going to be an amazing time. But that's why I'm doing these lives more frequently, because of how important it is to get ahead of these changes so we're proactive instead of reactive. And so like with my clients, I've sent out an email to them to do a home loan checkup, just to check up where are you at, where's your balances, what's going well, what's not, where do rates need to be to where it makes sense, and then put that trigger in. So as soon as the rates hit there, I contact them, they're ready to go. So they're proactive, a game plan in place instead of reactive. And that increases stress and cortisol. We don't want that. We want you to be happy, comfortable, confident in your decision. And if you're in a different state, let me know. I'll reach out. I can connect you with a great loan officer. But this is more meant to empower you to have these conversations with the loan officer you use to purchase your house. Before you go and talk to another loan officer, if the loan officer did a good job when you purchased, talk to them first and then talk to others. But this is an important thing. If they didn't do a great job, then it is what it is. But the market's improving. We're seeing rates come down. We're seeing prices come down for your monthly payment. So let me show you one other slide. Everybody's sharing it, but I want to make sure I put that up there for my people to see as well. So let me pick that out. Sorry, give me a second. All right. So a lot of people have been sharing this, and it's important. Let me move my head again out the way so you can see. So rates now are in the sixes. And so what that does on a $400,000 loan amount brings your payment down $263 a month. So right now that means your buying power might be a little bit higher, where you can go and find some additional properties that maybe you couldn't look at before, but prices for your payment are coming down because of the rates. This is huge. And again, let me move out the way so you can see this. It's awesome. And that's the principal and interest payment. This is for educational purposes and all that jazz. But this is something that you should see, because some people have been waiting and on the fence about buying because they're like, man, the payments are so high. But that's where you need to get with a licensed residential mortgage loan officer that's in the area, that understands the intricacies of that market, so they can walk you through some of the mindsets and plans to better utilize that market position to your benefit. Because you can always refinance later, but this is the least expensive homes are ever going to be. And you need to be prepared for that, and having people telling you the truth instead of telling you what makes your ears happy. I want to also show you some data, because I share this on every live, but this is so important for people to see a clear picture, because there's so much information online saying home prices are going to drop 15%. This is home price appreciation data since 1942. Hard facts, no feelings, data. Let me move my head. Screenshot this shit. The only time in our nation's history since 1942 that home prices dropped was between 2007 and 11. What happened in that time period? Absolutely atrocious lending guidelines, which artificially inflated demand, because if you could fog a mirror, you could get a loan. People were doing stated income loans. And if you could, like I said, fog a mirror, you're getting a loan. You could say you have making 500 grand a year, but you're really making 50. They'd throw you in a couple balloon mortgages and thinking that home prices were going to continue to appreciate the way they were back then. But let me show you why that should have been something everybody and their mama seen coming. And it's all based on home housing formations and housing completions. Again, I like to show people data, so we remove the emotion out of it and approach it from logic. This is think about how many wars, recessions, gas siphon shortages, and having to have lotteries for which days people are going to get gas in the 70s, and interest rates near 20% in the 80s. Yet home prices appreciate and are stable year after year after year, except for that time period when banks pretty much regulated themselves and made up absolutely atrocious guidelines. But we had laws put in place to protect our people from ever experiencing that kind of economic crisis again. Let me show you another set of data facts so that you can screenshot it and have it. Let me see, is this going to fit the screen? Come on now. All right. What's important is the data about housing formations and completions. Let's just look at the birthing rates in different generations. Between baby boomers and Gen X, a massive drop. But as we go from Gen X to millennials, it's 11 million more people. And 33 years is about the average age of a person purchasing a property. So when you look at the bottom chart, that's housing formations versus completions. You notice the orange completions were massively higher than the housing formations, meaning there's way too many homes being built. In 2006, it was the most homes ever built in a history. Look at the housing formations. And that properties being completed during that time period where prices dropped, were that entire period of time. Look at it. It was outpaced. But then look, 2015, we start to see the opposite. Housing formations outpacing completions, and it's continued in that trend up into this day. So when you have the most homes ever completed in history with a massive drop in population, as you can see right there in 1976, we had a huge drop in population. Or sorry, 1973. This isn't like rocket science, it's just data. They had this data back then. It's just that, again, greedy, selfish people who just saw dollar signs and it was booming economy, everybody's happy. But then we get hit because of lax lending guidelines, which we've tightened up and fixed. And this is why it's important for us loan officers to be out here teaching people and educating them so that they're not stuck in a cycle of missing opportunities. Because once again, home price appreciation data since 1942, 2/3 of the wealth we have in our country is tied to the equity we have in homes. It's just the facts. So the last piece I'm going to touch on this that's so important, and thank you for everyone who's joining. I'm Ron Toy with the Ron Toy team at Cross Country Mortgage. I'm a licensed residential mortgage loan officer. In 10 years, I've helped about 2,000 people along their home investment journey. I'm speaking to you from personal lived experience and professional lived experience because I've bought and sold multiple properties myself. Home values appreciate, it's consistent. But why this is so important and what you got to look at this in a different aspect is what's called cash on cash return. If you have $10,000, let's just say you have 10 grand and that 10 grand is invested and you get 10,000 shares or whatever for stock, and that stock goes up 10%, which is fantastic return, right? Everybody wants to see 10% return. That means you got $1,000 that year. Great. But you use that 10,000, the same 10 grand to go buy a $300,000 house, and that house appreciates at 10%. You made appreciation based on the value of the house. So it went up $30,000. So off of your $10,000 investment, you had 300% return because now you have $30,000. That is why investors are buying up as much property as they can, because it's hard to make those kinds of returns on a consistent basis, as you've seen. And as investors, if you miss the best trading days of the year, your return is abysmal. And that's why investing long term also helps against, help protect against inflation. And so this is why it's so important. Yeah, hey, this is so huge, cash on cash. Because like, especially with down payment and closing cost assistance, I'm going to do this little live on maybe tomorrow, the next day, showing you an example of a closing disclosure on a client I just closed last month where they bought a $300,000+ house and they got a check back at closing for their earnest option and appraisal money. And so in essence, they got their money back. Now they're going to, if that house goes up 5, 7, 10%, whatever the rate of return, their return is huge. Because if you're paying rent, you're paying a mortgage. It's just not your own. And this is something that is so scary, but it is not taught to people well enough, is opportunity cost. So if you're paying rent in a 1 or 2 bedroom apartment, it'd be significantly better for you to invest in a 1 or 2 bedroom condo with a similar payment. Because again, you're going to get equity growth two ways. One, for savings through principal balance reduction and appreciation. My husband and I bought our house last year, 200,000. When it was built in 1950, it was 50. That's what I'm talking about. And trust me, watch as rates drop, because every 1 point drop in rate brings another 2 to 4 million buyers back to the market, meaning more demand, which is going to increase prices. And right now, there's the most equity in homes that we've seen. The average equity position is around 60%, which is insane. So when people feel more comfortable to sell, what's going to happen is they're going to be cash rich, just kind of like what happened in 2020, 2021, where people were paying 20, 50, 100,000 over list, driving prices up. And so congratulations on getting in when you could get in. You're going to continue to see your properties appreciate. Do little things to keep up with it. But this is why I love to talk about it. You are growing your wealth two ways: appreciation and forced savings through principal balance reduction. Every time you make your payment, you're building equity. Yes, for the first 15 years, a lot of your payment goes to the interest, but you're still reducing your principal balance with every payment. And this is important. But this is also why you want to manage your interest and your equity position in a way that's, again, aligned with your current and long-term goals. Because if you know that you're going to be in the house 10 years and you bought last year when rates were probably 7, 8%, okay, I know I'm going to be in this home for a little bit longer. I'll go ahead and refinance down to 5 or 4.5 because it makes sense. I'm going to be in here long term. I want to make sure I manage my position. And maybe because you're comfortable with the payment where it was at 8% or 7%, maybe you shorten your term from a 30-year term to a 15 or a 20-year term. And now because your payment might be close to the same with the lower interest rate, but now you're paying your house off faster, saving yourself 100, 200,000 in interest. So there's so many cool, unique ways to structure and work on your loan to pay it off faster and apply more towards direct principal. And so that's another thing I'll be teaching on, is what's called recasting. And it's amazing. How do I know when it's a good time to renegotiate the interest? So that's why I'm so glad you're following me and on my lives. A good time is when, first, you want to have a consultation with what the loan officer that helped you with your purchase. If they did a good job, that's a conversation that you should call them, be like, hey, I was on a live today and I saw a loan officer talking about the interest rates. Where do rates need to be, in your opinion, for it to make sense for me to refinance, and like have them send you an analysis, a breakdown of where the rates would be at three, what the payment would look like at 4, 5, 6. So then you can see where you want it to be and then go from there. And if the loan officer didn't do a great job, schedule time and I'll talk with you and walk you through the process and make sure you're taken care of. But don't get there's so many loan officers that'll slap the hood of the car and talk about how cool it is and how much APR they can fit into it, and it'll be so sweet. You'll say 200 bucks, blah, blah, blah. All the sleazy sales stuff. That's not me. I'll let you know if it makes sense. And usually what it is if the cost to refinance is paid back within 12 to 36 month period, because the lending costs, like most loan officers are doing like no lender cost, which is cool. Exactly. Yes, we all know that. And so, Miranda, you're making me laugh. But that's what most loan officers understand it. But then most of the times you have to reset up escrow accounts. And so then that'll get rolled into the cost of the refi. So you have zero out of pocket, but that doesn't mean it's not rolling in cost. And so if that cost is more than the savings you would get by in over a 12 to 36 month process, maybe it doesn't make sense right now. That's where you want to look at it. And that's what we'll look at together and make sure that it makes sense. But again, if you're going to be in the house 10 years and you're saving $300 a month, you're talking $3,600 a year. And in that 3-year period, your cost to refinance and escrows, depending where you're at, probably $3,000 to $6,000. Cool. And if the loan officer's not crediting costs, maybe it's another $1,800. So $7,000, let's call it. Okay. Your payback period, your break even is 2.5 years. Done. That's a sweet deal. I'm saving money. I'm doing all this and makes sense. If you're going to sell in 2 years, maybe it makes sense not to hit that into your equity position and just kind of ride it out and list your property. Or maybe if you're thinking about selling in 2 years, maybe now is the time to sell and to capitalize on your equity position and go buy the property you want, use the equity that you got from the sale of your home to pay off debts, pay for the next property, and invest so that you have a big chunk of money in savings. I've talked to my clients about that several times. I mentioned this on my live yesterday. They called me wanting to get 20 grand out to pay off debts. They only wanted to be in their house another year. I was like, why? Sell your house, pay off your debts, because they got 60 grand. So they were able to use 23 grand to get into their new house, pay off all their debts, and still have about $20,000 left over, 25 grand left over to invest and have this survival account where now their income monthly is only servicing investments instead of debts because they have their survival account. And then once a quarter, they're just moving the money back over to replenish their debt servicing account. That blew their mind. It changes the way you work your money. When you don't have debt, you're not debt servicing, your income is now used and your capital is freed up so where you can invest and save for your future. That's why I talk about comfortably afford. Get what you can comfortably afford. If you're happy in a 1-bedroom or 2-bedroom apartment, great. Buy the cheap one, fix it up, and then after 12 to 24 months, use that as a rental property. Now you start to have passive income. If you buy a $80,000, $90,000 condo, your mortgage payment is probably about $700. You can rent it probably for $1,000, but this is where you want to work with a good realtor so they can do market rent analysis to see what makes sense. Again, that's why I talk about aligning with your current and long-term financial goals. But let's see. I'm definitely going to talk to you more. Facts, just DM me, message me. I'll help you. And if it's through Wells Fargo, yeah, we need to talk. So DM me for sure. And I'll help walk you through that because yikes sometimes. But again, long-term, short-term, what is the play? Because again, I've seen so many clients that miss out on buying a 1-bedroom apartment, staying in it for 5 years, thinking I'm not going to buy a house till I get married or have kids or whatever. I'm like, in that 5-year period, because opportunity cost, there's where my brain was. Opportunity costs. If you're renting, let's say it's $2,000 a month. That's $24,000 for the year. And say you bought, and for that same monthly payment, you could buy a $300,000 house. Okay, well, if that house goes up 10%, that's $30,000 that year in appreciation. So when you add the rent of $24,000 that you paid that year to the opportunity cost of missed equity gains through appreciation, that means that 1 year costs you $54,000. You're in the hole, 54 grand. You can't get that money back and you can't get that appreciation back. This is why there needs to be better communication to people across the board on why they keep getting further and further and further and further behind. It's that delayed purchase and investment into themselves. Because like I said, when you own a home, you get equity 2 ways. Forced savings through principal balance reduction. Every time you make your payment, you grow your equity because part goes to your principal balance and appreciation. But that opportunity cost of 54 grand doesn't count for tax liability reduction, doesn't count for the principal balance reduction part of your equity growth. It's just comparing the equity loss to your rent paid. That is staggering. And if you're in a different price point, think about it. If you're paying rent that's $5,000 a month and now it's 60 grand a year, and that's probably about a $600,000 house. And if that goes up 10%, it's 60 grand. You just cost yourself 120,000 in 1 year. And they're wondering why they're falling farther and farther behind. I'm not going to let the people that follow me do that. You don't have to use me. I'm a loan officer, but there's freaking thousands of us out here. Interview them, ask them questions. Why did you get in this business? What keeps you up at night about the business? How many properties have you bought in the last 3 to 5 years? When was the last time you bought a property? When was the last time you sold a property? These might not be questions you'd think to ask a loan officer, but it's important because while we do this every day, it is a totally different ballgame when it is our own deal, when it's our own investment. It's because now it's our skin in the game, and we're like, oh, I bought a house at the height of the interest rates in July because I knew we got a stunner deal. House appraised $50,000 over list. We got the sellers to pay us $26,000 in seller concessions. That wasn't happening earlier. And as rates drop, our house values continue to go up. So we have made a freaking stellar deal because we didn't allow fear to control and dictate our decisions. But this is where I want to validate. Buying a home is in the top 5 most stressful things a person does. Maybe they do it 2 to 3 times their entire life. So don't feel bad if you've been intimidated to invest in a property. It's easy to rent. Why is it easy? Because the power structure in and of itself is designed to keep us servicing debt and not building long-term generational wealth, because then that's easier to control a person. I don't like that. I am a freaking Scorpio rising dude. I am not about people controlling me, and I don't trust anybody. So I'm out here telling you information so that you can take it and go get confirmation from somebody that you know, like, and trust. I'm happy to be here to answer your questions too, but trust me, in this situation, in my own personal lived experience of buying multiple properties and selling multiple properties, if I could go back in time, this is the most important part of this live. If I could go back in time to 1920, like when I was 19 or 20, and I've shared this with my son, what I would do as a loan officer with my same understanding is I would buy a fourplex, live in one side, rent the other 3, stay in it 12 to 24 months, then buy another fourplex as a primary resident, rent out all 4 sides on the first fourplex, live in one side of the new fourplex, rent the 3, and then stay in that one 12 to 24 months, and do that process every 12 to 24 months, buying another fourplex, another fourplex, another fourplex. And in 10 years, by the time I was, 30, I'd have potentially 5 to 10 fourplexes. So we're looking at 20 to 40 doors, passive income, and never having to put 20% out of pocket, only 5% or 3.5%, depending on what type of loan program, or if it's in a USDA area, 0%. My son will be exponentially more wealthy than myself because I have knowledge and understanding and lived experience that my parents didn't. I can't get pissed with my parents for not having the same exposure of information because nobody is telling people this because it isn't meant for, it was guarded. And we know this historical data that there's been not just certain sections, a ton of people that were specifically targeted not to be able to build long-term generational wealth through home ownership. Because if you have wealth, you have power. And power terrifies tiny D energy people. And that is something that I enjoy doing. Let's terrify the current power structures and get as many people into homes so they can build long-term generational wealth. Exactly. That's what I'm saying. They couldn't teach you something they didn't know. They did the best they possibly could with the information data sets that they got. But think about what their parents lived through. Depending on how old your parents are, if they grew up in the Great Depression, like your grandparents, they were just trying to hold tight to money. They couldn't have the risk to invest. It's crazy. I call it mortgage literate. See, and that's the thing. We aren't. But imagine if schools would invest in this type of education. But this is why when TikTok first came out for the first year or two, I just lurked. I was watching videos, seeing how it worked. But then finally I was like, I got to start talking because this app is geared to the people I'm trying to help educate, younger generations. And now older people are getting involved too. But if I could help younger people start to build wealth and do things in a different way because they got some information from some dude they might not have ever talked about to, then great. I have fulfilled my commitment to this earth to better it. Then, instead of just complaining, I'm going to be the change I want to see in the world. I'm going to teach. And that's what I'm here for. But think about this in school. A squared plus B squared equals C squared. It's great. I'm glad that we know that shit. But I have yet to use that in my regular adult life ever in the history, and I'm 41 years old. My teacher, my math teacher, Miss Battle, if you're ever looking at this, guess what? I do have a calculator in my pocket. It's attached to my freaking cell phone, and it's got a scientific action in it too. Plus, I can ask Siri, and she'll tell me. So all the stuff that we got taught in math is important. We need to know how to do basic functions and all that stuff. I'm not knocking it. But imagine if we would have had a class that taught us how to properly purchase a property or how important it was to building long-term generational wealth. Everyone should be given this kind of information and walk through it. And also, like, if going back in time, thinking about parents, like my son just turned 20 in May, and he's off in the Air Force. But I've been showing parents, like, because think about kids going to college, and student debt is insane. Instead of your kid paying $40,000 a year to live on campus, that goes to nothing. Buy your kid a condo as a primary residence, 3.5% down because you're there. It's for your dependent. Buy them a 2-bedroom condo or a small house near campus if they're allowed to live off campus for the first year. They buy that house and live in it, and they rent a bedroom out or 2 to their friends that are on campus. That means they're helping cover the mortgage. They're building equity as they live in it. And now at the end of 4 years, they've got equity in a property that they can either sell to pay off any student debt or keep the property for passive income and rent that out and go buy another property as a primary. But now you have a way to control the flow and better utilize your money, because if you're paying the mortgage, you're building equity instead of giving it to some college that doesn't need the money. Let's help build our kids and our generational wealth, not continuing to fund colleges who don't care about us, that are gouging prices and charging books. When I went to school, I'm like, oh, yay, I'm here. And then I go to the bookstore and you almost spend more on books than the whole semester. And now you're like, and then you go to class and then they never even use the book. You're like, why was this required? Why is this? Why is this book $500? Why is this book $200? Let's fix the system and talk about it, how to game it and play it. I'm telling you how to get into property. Almost every state has down payment and closing cost assistance programs. Texas is awesome. We've got Seth, T-Shack, TDHCA, Chenoa, all of these options. And the client that got their money back, they use T-Shack, which you can go on and look it up online. Their rates are for everybody. Your loan officer takes care of it, but it's cool that the client can see the back end because it levels the playing field. Use T-Shack and Seth, everybody's costs, everybody's rates, all of it are the same. So, but they give up to 5% towards your closing costs and down payment when you're investing in a property. And if there are grant options available, that's a gift. So there's no repayment period. The other ones are in a 3-year forgivable second lien with no interest or payment as long as you stay in the property 3 years. But if you refinance or sell, you got to pay it back. But think about this. If you could go back in time to 21, 20, 22, you had a job for a couple of years. You're like, oh, what? I can afford this apartment. That's $1,000, $1,200, whatever rent was when you were 21. Imagine if you'd have bought a condo that had the same payment and you stayed in it for the same amount of time that you lived in your first apartment or second apartment or whatever, building equity. Because again, if we look at the home price appreciation data, which I'll pull up one more time before I'm done this live, but if we pull up the home price appreciation data, imagine what equity position you'd be sitting on. And again, this is why I always talk about it, because building long-term generational wealth is something I want to make sure to communicate to people. So again, let me move out the way. So there you go. Imagine if you were in 2012, you bought a $100,000 house, a condo that went up 6%. Now it's 106. Then it goes up 11%. Now you're looking at like adding another 10,600 or another 10 grand to it. Then it goes up 5, 11. By the time we get to right now, you're sitting on probably 200,000 in equity. Because like, imagine if you're 30 and you have 200 grand in the bank, you don't have to use the whole 200 grand to go buy your next house. You can use 20 grand, take 50 grand, sit it aside to a year's worth of your debts, and then use the other part to springboard retirement, invest, maybe buy another property, whatever you want to do, but that's your money. It's amazing. But this stuff gets me excited, and I love to show unique ways to get people done. especially younger, because some people are like, oh, I don't, my job, I don't get paid. Let's talk and then get on a game plan. And like I said, interview your loan officer. But if you're 1 year out, 2 year out, 3 year out, doesn't matter. The time's going to pass whether we like it or not. Like 2 years going to pass, 3 years. It is what it is. But are you on the right train tracks to get you to your destination? Or are you just winging it and just raw dogging life and not caring about what's happening? You're just like, I'll just figure it out. Well, that's not the best use of your time, because if we can save you a year or two off of that and you're building your money and you're building your generational wealth, I want you free. Maybe you build up 2, 3, 4, 500,000 in equity over a 10-year period. And you're like, you know what? I'm out. I'm going to Thailand. I just watched a video where this lady got like what would have cost us $100,000 in medical stuff for like $700. I'm like, done. Go live like a king somewhere. Have fun. But like, let's get you free. Let's get you building long-term generational wealth. If you have questions, put in the comments, but also book your time on my profile. Like, you go to it. I'm not technologically savvy. I'm getting better. I'm like about 6 or 7-year-old kid with an iPad. So maybe 5. But whatever the wizard term is for it, on my profile, there should be links to like my link tree, and it has like my calendar. Go ahead and get there, and I'll help you walk through this part. I want to pay off my debt, get a 4-bedroom house. New baby needs its own room. Absolutely. Something to think about too on that. As you get a bigger house, your bills increase. And if it's a baby, depending on how old it is, my son, like, usually they'll sleep in a bassinet or playpen for a while, but we should look at it. Let's look at paying off your debt, because maybe, depending on where your equity position is in your house, maybe you could get all of that right the frick now, if you sold your property, paid off your debts, and then used a portion of your money to go and get into another property. So maybe your goal of that 4-bedroom house is a little bit closer than you thought, but you got to have a conversation. Maybe it's not right now. Maybe it's a year from now. Maybe you need to know where the equity position needs to be to pull the trigger to pay off all of your debt and get ahead of it. I also do debt reviews with all of my clients to show them a path to paying off their debts quicker, and it's free. And so that they have, again, value added to them outside of just like a transactional relationship. I want to make sure my clients are taken care of. So I'm going to give them debt analysis, mortgage analysis, everything, whatever they need. Like, it's not just a transaction, but let's look at that together, put together a game plan and a timeline to see when that's possible. Because if you have a goal, if you don't write down the action steps needed to achieve the goal, you have a wish, and that's not going to come true. We're not genies. But if we got a goal and a game plan, we can put a roadmap together and execute the plan. So that's what I like to do. So maybe we get that done. So check the links. I got my Calendly open, and you can pick a time that works for you. Consultation, mortgage planning session. We just have a conversation first before you have to go through the process of applying and all that jazz. Obviously, if you want to, go ahead. But let's talk before people go through the long process of that. Make sure that everything aligns, again, with your current and long-term goals. There's so much opportunity out there. I don't want you to get inundated with the wrong information. The other thing, I'll share this tomorrow, so be back on my live tomorrow. It's optoutprescreen.com. Right now, there's so many data mining companies that are selling our data, and the credit bureaus sell it. And they call it public information, but it's annoying because you get marketing crap all the time. And I don't want you to get inundated with that, especially as it's coming up, because you can opt out of electronic stuff, but you can also mail in a thing to opt out of stuff mailed to your house. And so I want to protect you, make sure that you're set and you're not getting your data scammed. But yes, opt out pre-screen. I'll go into detail on that on my live tomorrow. If you have questions, shoot me an email, schedule time on my calendar. Stay tuned. I'm going to do these lives on a daily basis. Sometimes it'll be at different times of the day, but I usually put out an announcement of, hey, I'll be going live at X time, to give you opportunity to save it. But I also download these and then upload them to my YouTube channel, so that people can reference back and go and watch the beginning if they missed any part. Usually I get it uploaded to my YouTube channel within like a day or two, but I try to do it right immediately after the live. Appreciate everybody's time today. Yeah, like I said, reach out, do the things, but I'm excited to be here giving you information, helping make sure that you can make a proactive, informed decision to either buy or refinance. And yeah, have a great one.